Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today. If you're thinking about retirement or maybe already living it, then this episode is just for you.
Absolutely, Emily. One of the biggest challenges people face when planning for retirement is managing their emotions, especially when it comes to investing.
Exactly. It's so easy to get caught up in the highs and lows of the market, right? We're going to dive into how to avoid those emotional investing mistakes that can really derail your retirement plans.
And we'll also touch on practical strategies to help you stay focused on your long-term goals, even when the market gets a little rocky.
Yeah, and let's not forget the importance of having a solid financial plan in place. It can really make a difference in how you navigate those emotional waters.
We'll discuss the role of diversification, the power of staying informed, and, the importance of having a trusted advisor by your side.
All of that is so crucial. So whether you're just starting to plan or you're already in retirement, there's something here for everyone. Let's jump right in and start exploring these emotional investing pitfalls.
Emily, it's really crucial to understand why avoiding emotional investing mistakes is so important right now. With all the market volatility we've seen lately, it can be pretty easy to get swept up in the emotions.
Absolutely, David. I think a lot of folks are feeling anxious about their retirement timelines, especially with inflation creeping up. It's like they might have had a solid plan, but now with prices rising, everything feels uncertain.
Right, and that uncertainty can lead people to make hasty decisions. I remember speaking with a couple, let's call them Tom and Linda. They were getting close to retirement, and when the market took a downturn, they panicked. Instead of sticking to their plan, they sold off a significant portion of their investments and ended up locking in their losses.
That's such a common story. It's like, when you see your portfolio drop, the instinct is to react quickly. But, as you always say, David, it's important to remember why you invested in the first place.
Exactly. Many retirees have a long time horizon. They may need their savings to last 20, 30 years or more. Selling in a downturn means missing out on potential recovery when the market bounces back.
And not just that, but there's also the impact of inflation. If you're too conservative with your investments because of fear, you might not keep up with inflation. It's like trying to outrun a bear, but you're only just walking.
Haha, right. You're not just trying to avoid the bear. You've got to keep moving forward. And speaking of inflation, it's not just affecting investment decisions. It's also hitting everyday costs. Healthcare, for example, is a huge concern for retirees.
Oh, for sure. I've heard stories from retirees who thought they had enough saved up, but once they faced unexpected healthcare costs, it threw everything off balance. It's a real wake-up call.
Precisely. Let's not forget about the changes in Social Security, too. With adjustments happening annually, it's essential to plan for how those benefits might change. If you're not paying attention, you could be leaving money on the table.
Right. And it's really about understanding the bigger picture. If someone's investments are too conservative because they're emotionally reacting to the market, they might find themselves in a tight spot later on, losing out on those crucial benefits.
Yeah, and then there's tax efficiency. With all the changes in tax laws and rates, it's important to be proactive. If you're not careful, you could end up with a tax burden that eats away at your retirement savings.
Exactly. It's all interconnected. I know a few retirees who didn't consider the tax implications of their withdrawal strategies. They ended up with a much higher tax bill than they anticipated, which left them scrambling for cash.
That's a tough lesson to learn. And let's not forget about legacy planning. It's a big part of financial security. If you're not thinking ahead, you might not leave your loved ones in the best position.
Like the story of Susan, who wanted to leave a little something for her grandchildren. But because she was too focused on avoiding market risk, she didn't grow her assets enough. Now she's concerned about whether she'll have enough to pass on.
Exactly, and that's where the emotional side of financial security really comes into play. It's about feeling confident in your decisions. When you're feeling overwhelmed, it's easy to lose sight of your long-term goals.
Yeah, and I think many people underestimate how much their emotions can influence their financial decisions. It's not just about numbers. It's about peace of mind, too.
Right, and the current economic trends are only amplifying these feelings. With all the news about potential recessions or economic slowdowns, it can make anyone feel uneasy about their future.
So true. It's like a perfect storm of factors that can lead to poor decisions if folks aren't careful. But that's why we're having this conversation, to highlight the importance of staying grounded in your plan.
Absolutely. And by understanding these emotional triggers, retirees can focus on their goals rather than reacting to the market. It's all about having the right strategies in place.
Speaking of strategies, what do you think are some core approaches that can help listeners avoid these emotional investing mistakes, especially during turbulent times?
Well, for starters, having a well-defined investment strategy tailored to your risk tolerance is key. It gives you a roadmap to follow, which can be incredibly grounding when the market gets bumpy.
That makes sense. Having that plan can really help you stay on course, even when emotions run high. What else should they consider?
Regularly reviewing your financial plan and making adjustments when necessary is also crucial. It's not a set it and forget it situation, especially as life circumstances change.
So true. And I imagine having a trusted advisor can really help keep those emotions in check too, right?
Definitely. An advisor can provide an objective perspective, helping you make informed decisions rather than emotional ones.
All great points, David. It's really about building that resilience and staying focused on what matters most in retirement.
Exactly. And that's the cornerstone of achieving financial security. So when we talk about emotional investing mistakes, one of the first things that comes to mind is the importance of having a solid plan in place, right?
Absolutely. I think having that plan can really help you stick to your strategy, especially during market fluctuations. But David, what are some core strategies that listeners should consider in their retirement planning?
Great question, Emily. Let's start with asset allocation. A common rule of thumb is the 70-30 portfolio. Having 70% in stocks and 30% in bonds. It's a balanced approach that can help manage risk while still aiming for growth.
Right, and that balance is crucial, especially as you're nearing retirement. So how do you decide how much to allocate to each?
Well, it often depends on your risk tolerance and your time horizon. If you're, say, 5 years away from retirement, you might want to gradually shift more towards bonds to protect your capital.
Yeah, shifting gears makes sense. And speaking of time horizon, how does that play into tax-advantaged accounts like 401ks or IRAs?
Tax-advantaged accounts are a fantastic way to save for retirement. For instance, with a 401k, you can contribute pre-tax dollars, which lowers your taxable income. Plus, many employers offer matching contributions. That's essentially free money.
Right, and with IRAs, you have the option of a traditional IRA, where you get tax deductions up front, or a Roth IRA, where your money grows tax-free, right?
Exactly. The Roth IRA can be especially beneficial if you expect to be in a higher tax bracket in retirement. Just imagine, your withdrawals later on are tax-free.
That sounds appealing. But I guess it's important to consider how much you're able to contribute and the rules around that.
Yes, there are contribution limits which can change each year. For 2023, for instance, you can contribute up to $6, $500 to an IRA if you're under 50, and $7, $500 if you're 50 or older.
Those catch-up contributions are definitely helpful for those nearing retirement. Now, what about withdrawal strategies? I know the 4% rule is often discussed.
The 4% rule is a classic guideline that suggests you can withdraw 4% of your retirement savings each year without running out of money. It's based on historical market performance, but it's not foolproof.
Right, because market conditions can change. Some people might prefer a more conservative approach, like the bucket strategy. Can you explain that a bit?
Sure. The bucket strategy divides your investments into 3 buckets. The first bucket covers your short-term needs, typically cash or cash equivalents, for the first few years of retirement. The second is for midterm needs, maybe a mix of bonds and stocks. And the third is for long-term growth, heavily invested in stocks.
That really helps in managing risk, doesn't it? You can ride out the market's ups and downs in your long-term bucket while still having access to cash for daily expenses.
Exactly. And it also helps to keep emotional investing at bay. If you know you have enough cash to cover your expenses for a few years, you're less likely to panic during market downturns.
Yeah, that peace of mind is invaluable. Now, what about Social Security optimization? How does that fit into the overall strategy?
Social Security can be a significant part of your retirement income, but deciding when to take it is crucial. You can start as early as 62, but your benefit will increase for each year you delay up to age 70.
So if someone can afford to wait, they might want to maximize their benefits.
Definitely. For instance, if your full retirement age is 67 and you wait until 70, you could get about a 24% increase in your monthly benefit. That can add up significantly over time.
That's a good point. And I assume it's important to consider your overall financial situation when deciding when to claim?
Absolutely. If you have other income sources like a pension or significant savings, it might make sense to delay your Social Security.
And we can't forget about tax implications, right? There are strategies to minimize taxes on your retirement withdrawals.
Yes, tax management is key. For example, if you have both taxable and tax-deferred accounts, you might want to draw from your taxable accounts first in retirement to allow your tax-deferred accounts to grow longer.
That can help minimize your tax burden. And what about diversification? I know that's a big part of avoiding emotional investing mistakes.
Exactly. Diversification is like not putting all your eggs in one basket. You want to spread your investments across different asset classes, stocks, bonds, real estate, to reduce risk.
Right, because if one sector is down, another might be doing well.
Precisely. It's about balancing your risk and ensuring that your portfolio is resilient in different market conditions.
And that's something you can adjust over time as your needs and risk tolerance change, right?
Yes, rebalancing your portfolio is important. Maybe once a year, you should take a look at your asset allocation and adjust it back to your target levels.
That makes sense. It sounds like having a disciplined approach can really help prevent emotional decision-making.
Exactly. And remember, it's also beneficial to keep an emergency fund. Having that safety net can help you avoid dipping into your investments during market downturns.
So true. It's all about setting yourself up for success and avoiding those emotional pitfalls.
And speaking of pitfalls, we should transition into discussing some common mistakes that people make when they let emotions guide their investment decisions.
Yes, I think that would be really helpful for our listeners to understand.
So, Emily, let's dive into some common pitfalls that people face when planning for retirement. One of the biggest ones I see is this. Emotional investing mistake, especially when it comes to the sequence of returns risk.
Right. That's a big one. Can you explain what that means for our listeners?
Sure. So, sequence of returns risk refers to the order in which your investment returns occur. If you experience significant losses early in retirement, it can really hurt your portfolio's longevity. For instance, let's say someone retires in a year when the market takes a dive. They start withdrawing money to live on, and that can really diminish their savings, right?
Yeah, that makes sense. I mean, withdrawing from a shrinking portfolio can create a downward spiral. Have you seen this happen with clients?
Absolutely. I had a client, let's call him Tom, who retired right before the 2008 financial crisis. He had a solid nest egg, but because he was withdrawing from his investments during that downturn, he had to sell at a loss. By the time the market recovered, his portfolio was severely depleted. He was in a tough spot.
Ouch! That must have been really stressful for him. So what can people do to avoid this pitfall?
Well, it's crucial to have a diversified portfolio and a solid withdrawal strategy. One approach is to set aside enough cash or safe investments to cover living expenses for the first few years of retirement. That way, you're not forced to sell stocks during a downturn.
That's a great tip. What about taxes? I've heard that people often overlook the tax implications of their withdrawals.
Absolutely, and that's another common mistake. Many retirees don't consider how taxes can impact their income. For instance, if you're withdrawing from a traditional IRA or 401k, those withdrawals are taxed as ordinary income. If you're not careful, you could end up in a higher tax bracket, which reduces your overall income.
That's a great point. Do you have any examples of how this has impacted someone's retirement plan?
Sure. I had a couple, let's call them Mike and Sarah. They started withdrawing from their retirement accounts without considering the tax implications. They ended up bumping into a higher tax bracket and were shocked at how much they owed at tax time. It really cut into their budget for that year.
That sounds frustrating. So how can someone avoid that?
Planning ahead is key. It's important to understand your tax situation and, if possible, to have a mix of taxable and tax-advantaged accounts. Working with a tax advisor can also help you create a strategy that minimizes taxes over time.
Great advice. Now let's talk about healthcare and longevity. I feel like that's another area where people underestimate the costs.
Yes, absolutely. Healthcare expenses can be a huge drain on retirement savings. Many people don't realize how much they'll need to cover medical costs, especially as they age.
Right, and with rising healthcare costs, it's easy to see how someone could be caught off guard. Do you have any stories that illustrate this?
Definitely. I worked with a client named Linda, who thought she had enough saved for her retirement. She planned for her living expenses but didn't factor in healthcare. A few years into retirement, she faced unexpected medical issues that required costly treatments. She had to dip into her savings more than she anticipated, which really affected her long-term plans.
That's tough. What could she have done differently?
It's essential to plan for healthcare costs early on. Consider looking into long-term care insurance or setting aside a specific fund for medical expenses. And remember, Medicare doesn't cover everything, so it's important to have a realistic view of potential healthcare needs.
So true. Now, what about asset allocation? I've heard that mismanaging this can lead to big problems too.
Yes, asset allocation is crucial. Many retirees tend to become overly conservative with their investments after retiring, which can limit growth potential. For example, I had a client named Jim who moved almost all his investments into bonds because he was scared of market volatility. While it felt safe in the moment, it ended up underperforming and left him with less growth than he needed.
That's a great example. So how can retirees strike the right balance?
A good approach is to keep a diversified portfolio that includes a mix of stocks and bonds. It's also important to reassess your risk tolerance periodically. Working with a financial advisor can help create an allocation strategy that aligns with your goals and time horizon.
Fantastic advice. Now let's talk about Social Security. I know many people claim benefits too early, thinking it's the best option.
Yes! Claiming Social Security too early is a significant mistake. If you claim benefits at 62, instead of waiting until your full retirement age, you could be leaving a lot of money on the table.
Do you have any examples of this?
Sure. I had a client named Karen who claimed her benefits at 62 because she thought she needed the income right away. She didn't realize that by waiting until 70, her monthly benefit would be significantly higher. Now she's dealing with a reduced income for the rest of her life.
Wow, that's a big difference. What should people consider before claiming?
It's essential to think about your overall financial situation, health, and how long you expect to live. If you can afford to wait, it's often beneficial to delay claiming benefits to maximize your monthly income later on.
That makes a lot of sense. So to wrap up this section, what are some red flags that people should watch for in their retirement planning?
Great question. Look for signs like consistent withdrawals from your savings that exceed your planned budget, a lack of diversification in your investment portfolio, or feeling overwhelmed by financial decisions. If any of these are happening, it might be time to reassess your strategy.
Thanks for sharing these insights, David. It's so important for our listeners to be aware of these pitfalls and how to avoid them.
Exactly. And remember, it's never too late to make adjustments. Planning for a secure retirement is an ongoing process, and being proactive is key.
Absolutely. So what's next for our listeners?
Well, the next steps involve reviewing your financial plan, assessing your asset allocation, and perhaps consulting with a financial advisor to ensure you're on the right track.
Sounds like a solid plan.
So let's dive into some immediate steps our listeners can take right now to avoid those emotional investing mistakes.
Absolutely. I think starting small is key, right? Like, one of the first things people can do is set aside a bit of time every quarter to review their portfolios.
Yeah, exactly. Just a quick check-in can help you stay on track. It doesn't have to be a huge commitment. Maybe just half an hour every few months.
Right, and during that time, maybe they can run some retirement projections too. That's where tools like Vanguard or Fidelity really come in handy. They have those calculators that can give you a clearer picture of where you stand.
For sure. And I'd recommend checking out ssa.gov for Social Security estimates. It's so important to know how much you can expect from that, as it's a big part of most retirement plans.
Oh, definitely. And speaking of planning, have you heard about some of those financial planning apps? They can help track spending and savings, which is crucial.
Yes, apps like Personal Capital or Mint can really help you visualize your financial situation. It's like having a financial dashboard right in your pocket.
Exactly. And they can help identify areas where you might be overspending or undersaving. which is super helpful when trying to avoid those emotional decisions based on market movement.
Absolutely. And, for those who love reading or listening to podcasts, there are some great resources out there. Books like The Intelligent Investor by Benjamin Graham or Your Money or Your Life by Vicki Robin can be real game changers.
Those are classics. And for podcasts, I'd recommend The Retirement Answer Man with Roger Whitney. He offers practical advice that can really speak to listeners at any stage of retirement planning.
Great suggestions. It's all about building that knowledge base, right? The more you know, the more confident you feel about your decisions.
Exactly. And it's never too late to improve your plan. Even if you're nearing retirement, making small adjustments can really pay off.
Yes, and developing good habits is a big part of that. Like, aside from quarterly reviews, maybe they can also set a reminder to check in on their investments whenever there's significant market movement.
Totally. Just to avoid that knee-jerk reaction, right? And if they find themselves feeling anxious about the market, taking a step back and assessing their long-term goals can help bring clarity.
Right. Emotions can cloud judgment, so having a plan in place helps mitigate that. Also, running those projections regularly can give you peace of mind.
Exactly. And if they find themselves struggling with the numbers, that might be a good time to consult a financial advisor who can provide personalized guidance.
Definitely. A good advisor can help keep emotions in check and offer a fresh perspective on your plan, but that doesn't mean you shouldn't also take ownership of your financial future.
Right. It's about empowerment. You can take control of your financial journey while still having support when you need it.
Yes, and remember, it's all about consistent action. Small steps build up over time, so even if it feels daunting now, just starting with those quarterly reviews can lead to big changes.
Absolutely. And for those who might feel overwhelmed, breaking it down into bite-sized tasks can make it a lot easier to handle.
Exactly. And keep in mind that tools like tax software can also be beneficial, especially during tax season. They can help you maximize deductions and plan for future tax implications.
Oh, great point. You want to consider how taxes will affect your withdrawals in retirement? Being proactive is crucial.
Yes, and while we're talking about tools, don't forget about investment platforms like Charles Schwab or TD Ameritrade. They often have educational resources that can help you understand market trends without getting too emotionally invested.
So true. They provide a lot of insights that can help you make informed decisions rather than emotional ones.
Exactly. And just to reiterate, it's never too late to start improving your plan. Whether you're just starting out or nearing retirement, taking these actionable steps can make a significant difference.
With these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today.
Well, Emily, as we wrap up, I think it's really important to highlight some key takeaways from our discussion on emotional investing mistakes.
Absolutely, David. I mean, the first thing that stands out is the importance of having a solid plan in place, right? It really helps you stay focused during those emotional moments.
Exactly. And then there's the idea of keeping a long-term perspective. The market can be volatile, but those who stick to their plan, they tend to fare better in the long run.
Yeah, and let's not forget about the role of diversification. It's like not putting all your eggs in one basket, right? It can help cushion you during market downturns.
Very true. And then there's the need to manage our emotions, especially fear and greed. Those can be powerful forces if we let them take the reins.
Right. Taking a step back or even consulting with a financial advisor can really help keep those emotions in check.
Well said, Emily. And just remember, building and protecting your retirement wealth is a journey. It's about making informed decisions that align with your goals, not reacting to every market fluctuation.
That's such a good point. It's about staying the course and being proactive rather than reactive.
Absolutely. And for our listeners, we'd love to hear from you. If you found value in today's episode, please like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
Yes, and don't forget to share this episode with someone who's planning for retirement or already in it. You never know who might benefit from this information.
And next time, we're diving into tax-efficient investment accounts. It's going to be an eye-opener, so you won't want to miss it.
Thanks for joining us today, everyone. Take care, and we'll see you next time.
Bye for now.